Let's talk about what's happening in Japan today. What message should global bond markets take away from the JGB picture?
Yeah, I think the path of least resistance is for yields to keep climbing higher. I know the currency's been sending mixed signals. It's kind of been detached from what we're seeing in long-term yields. But if you look globally at the moment, everything is just creeping higher. So JGB yields creeping higher because of rate hikes. In France, yields are climbing higher because of the fiscal situation there. We saw the Bundesbank report on Friday out of Germany. That's added upside to global bond rates. And then we saw that kind of hawkish hold from the cut from the Bank of England last week, which is all adding upward pressure. And I think the interesting thing here is the outlier potentially is what's going on with the Fed. They're looking to be cutting rates, but as we've seen throughout this cycle so far, rate cuts don't necessarily equal downside in yields. And I think there's a lot of potential for the US to potentially get swept up in this. And if you take the US for example as well, one of the main themes in this year has been fiscal largesse, and I don't think that's something that's necessarily going to be going away. We're heading into a midterm election year. The Republicans aren't polling particularly well, and we may see a situation where Trump needs to kind of pull the fiscal levers to try win the electorate over. We've seen things like tariff checks, for example, be touted. Yes, we got the Supreme Court ruling, which could potentially cause some issues, but the administration is still confident that they're going to be able to enact those. And as you mentioned in your introduction as well, from an inflation standpoint, one of the main inputs is energy. We've seen climbs in energy prices because of Venezuela. And then if you take things like copper, gold, silver, those metal prices are all climbing higher as well. So I think globally, the path of least resistance is for yields to keep climbing higher.
OK, so that's the global narrative. And then homing in on the US, you think curve steepness is what's going to dominate the conversation, will it, in the first, quarter?
Yeah, I think we're in a bit of a macro dead spot at the moment. We're not really going to learn anything for the next few weeks. It's not until we have the inflation and labour market reports for December that get released in January. I don't think we're going to learn anything there, but I think they'll probably skip in January. We'll probably get a cut in March. There's potential for another later in the year, which could add some pressure to the front ends of the US yield curve. But even if it is relatively anchored, for the reasons I mentioned, I do think there is potential for back-end rates to climb. And also, I think, certain issues like Fed independence haven't gone away. That's been incredibly thematic throughout the year. But one thing I'm kind of, looking at is, OK, if Trump has his person in the chair and they're not able to enact his rate-cutting agenda, what happens then? The pressure that he put on Powell this year could be even more intense on whoever, gets the top job next year.
Let's talk a little bit about kind of how this impacts other markets. You get higher yields. What do equities do? What are the spillover effects?
So I think, the obvious, way to look at this is the AI trade. That's everyone is getting increasingly nervous. We've seen some of the wobbles over CapEx plans. You've seen the likes of Oracle get hit. And I think, the AI trade is clearly maturing, but we're getting to that point where investors are wanting to see more returns on their investments. And if that's in the, kind of taking place, an example where, rates are rising, those pressures are only going to probably intensify. And one of the positives for the US equity market we've seen over the past few weeks is we've seen increased participation from small caps. Well, that's obviously a positive, but the one thing small caps don't want to see is increasing yields. So that could potentially, pose some headwinds for the US equity market at the same time.